Welcome everyone to Token Topics. I hope you're doing great. We're going to dive into the world of Ripple and XRP. We're going to go over Ripple's new global public policy as they prepare for mass adoption. That is exciting. Also, we're going to go over the world of CBDCs in Ripple and their utility. And whether we have CBDCs or not, you're still sitting in a good position if you're holding XRP, and I'm going to go over and explain why. Also, we're going to get filled in on the lawsuit, and we're going to hear words from Brad Garlinghouse at Davos on a couple different topics. So if you're an XRP fan, please subscribe so you can stay up to date, and also hit the like button. It does help the algorithm so more people like you can find this video. With that out of the way, let's dive in. I have a very brief DCENT wallet announcement. We are thrilled to announce a groundbreaking collaboration. DCENT has integrated with Meta Oasis, a revolutionary metaverse platform built on Avalanche blockchains. This strategic alliance propels our commitment to providing users with a secure, streamlined, and comprehensive experience in navigating the decentralized metaverse. Meta Oasis stands as a pioneering metaverse platform seamlessly integrated into the Avalanche blockchain, offering users with a transformative experience by embracing the principle of with Grow. Meta Oasis creates a thriving environment for users and the system, unlocking boundless creativity and economic opportunities such as AI model training tools, AI model creator tools, onboarding with over 20 mini games, cross-platform Web3 content publication, and much more. If you're interested to learn about this, the link is in the description. Ripple is truly revolutionizing enterprise payments. They posted that Ripple works with financial institutions, regulators, and central banks around the world to develop regulatory frameworks for crypto and blockchain. Let's check out this article. Ripple's policy principles. Emerging technologies such as cryptocurrency and blockchain necessitate innovative approaches to regulation. Safeguarding consumers and markets through regulatory measures remains essential, and encouraging innovation and expansion should be the central to any policy framework. We firmly believe that transparent communication and collaborative efforts between both private and public entities are vital in shaping an effective regulatory landscape for cryptocurrencies. This is why we have actively engaged in discussions with a diverse array of policymakers around the world. These dialogues have offered insights into the kind of regulatory clarity sought by the cryptocurrency industry and a broader ecosystem, as well as the expectations regulators have for the industry. As the ongoing discourse persists, Ripple has a vision for a practical regulatory framework governing cryptocurrencies, blockchain-powered payments, and digital assets. Ripple looks forward to a regulatory framework that not only nurtures the untapped potential of crypto and blockchain technologies, but also establishes essential safeguards for consumers and market stability. Here we go. Adopt a globally consistent taxonomy. It's very important. Currently, there is no single or generally recognized definition of a crypto asset. Consistent with the approach taken by some jurisdictions like the United Kingdom, UAE, Japan, and Singapore, which have issued classifications that depend on the inherent characteristics of a token and the rights attached to it. There should be clear distinction between payment tokens, utility tokens, and security tokens as outlined below. Payments or exchange tokens to describe non-fiat native digital assets that are used as a means of exchange and have no rights that may be enforced against the issuer. Utility tokens to describe those digital assets that create access, rights for availing service or a network usually offered through a blockchain platform. Security tokens to describe tokens that create rights mirroring those associated with traditional securities like shares, debentures, security-based derivatives, and collective. Number 2, implement a risk-sensitive regulatory framework. A regulatory framework should be technology agnostic, and it should not explicitly or otherwise endorse any particular technology. There should be parity in the treatment of all technology given the dynamic nature of crypto assets. Prescriptive regulation risk becoming outdated, hindering innovation, and unwittingly increasing financial stability risk. Instead, a regulatory framework should be principles-based, steering market participants to specific regulatory and policy objectives while maximizing flexibility and breadth of application. Any regulatory framework should use a risk-based approach to identify crypto asset services that pose sufficient risk to warrant regulation. Number 3, foster innovation sandboxes. Innovation sandboxes should be fostering for market participants to test new and innovative products, services, and business models, and with end users in a controlled environment while being subject to regulatory oversight. Innovation sandboxes should be encouraged to incentivize forward-thinking innovation and inform the development of a clear, consistent regulatory framework for crypto assets. Number 4, encourage public-private collaboration, which is extremely important. Any public framework intended to regulate crypto assets should promote an active dialogue between regulators and market participants to better achieve regulatory clarity. Such public-private collaboration will lead to more appropriate and effective policy outcomes for the industry and consumers alike. A collaborative forum that brings regulators and industry stakeholders together to build a rational and holistic framework for blockchain and crypto assets would represent a substantial step forward achieving regulatory clarity. And now number 5, ensure global consistency and comparability. Given the cross-border nature of crypto asset markets, minimum global standards are necessary. These standards should be supported by cross-border cooperation and information sharing across jurisdictions to help ensure an approach that is consistent and comparable. Enabling greater mutual recognitions of licenses across jurisdictions would be a natural benefit of adopting common minimal international standards. It is important to note that mutual recognition decisions already exist for traditional financial institutions and infrastructures. Now, I'd like to go over the important topic of central bank digital currencies. There is a lot of questions in the community wondering, what does this actually mean for XRP? If they have central bank digital currencies, does this mean that XRP really won't have any value? Is there even a point to hold it? Or what if there isn't central bank digital currencies? What does that mean for XRP? Donald Trump, he took the stage not long ago and he announced that he is not going to stand for CBDCs, for central bank digital currencies. But keep in mind that either way, if there are going to be central bank digital currencies or if there's not, we're still sitting in an excellent position. They still need on-demand liquidity. They still need this technology to flow this value around the world. The liquidity issues are issues that they are real issues that they're having, okay? Now, some people might think that XRP won't have value if there are CBDCs, and that's not true. In fact, David Schwartz, he actually cleared this. He says you still need a bridge currency, and that's the whole idea of XRP, was to be a bridge. And businesses, financial institutions are going to be more prone to want to use the asset that's native to that ledger. There's going to be interoperability between multiple ledgers, don't get me wrong. But the first of choice is typically the asset that is native to that ledger. So if they're utilizing Ripple's technology, they're going to use XRP ledger. There's a good chance that they're not going to choose another asset, that they are going to use XRP. So that's the good news. You still need a bridge. That value still has to cross, okay? Now, what if they don't have central bank digital currencies? There's still the elimination of the Nostro Vostro accounts still stands. The on-demand liquidity, it still stands. So either way, what I'm trying to explain to people is that if you're holding these assets that's made for this liquidity, that's made to transfer this value around the world, you are sitting in a win-win position. No matter what, this technology is overtaking Swiss old technology. It's taken over other technologies because it's instant. It's live. You can see what's actually happening on a ledger. This technology is revolutionizing the industry. So again, you're sitting in a very good position, whether you're holding XRP, if there's a CBDC, or whether you're holding XRP and there's not. I'm going to skip ahead here so we have an understanding of how big this is. Now, the rest of the world is pursuing CBDCs. Whether United States will pursue it or not, it seems in the long run that the world is headed in that direction. Now, I'm a fan of blockchain technology. I'm a fan of crypto and digital assets. I'm not really a fan of the big banks and CBDCs, but if it does come like I stated, we're going to be in a good position. I would not want to be in a position not holding any digital assets, either CBDCs come or not. So today, 130 countries representing 98% of global GDP are pursuing CBDC projects. Some include the United States and South Africa have entered exploratory phases. Many projects throughout the European Union are in development, while China has reached a pilot phase and is nearing full-scale launch in mainland areas. The Atlantic Council reports that 19 of the G20 countries are now in advanced project stages. So what does that tell you? Continues here that elsewhere, including in Nigeria and the Bahamas, solutions have been launched and use cases continue to evolve. The Bank for International Settlements now predicts that 20% of the world's population will have access to a CBDC within the next few years. Now, considering the advantages of CBDCs, in a recent Ripple survey of global financial institutions leaders, 85% of respondents think that their country will launch a digital currency within the next 4 years. The majority of leaders cited financial inclusion as a key CBDC benefit, and many of them feel the technology will deliver enhanced national competitiveness, 44%, ensure greater efficiencies within payment systems, 43%, and advance innovation more broadly, 42%. According to McKinsey, CBDCs may help central banks address systemic objectives, including ensuring financial inclusion, reducing fraud and money laundering, stimulating payment innovations, and creating new vehicle for monetary policy, among others. Worldwide jurisdictions appreciate various CBDC functionalities for a range of reasons. For instance, some recognize the opportunity to expand the position of currency reserves made up of sovereign money, or the money issued by a monetary authority versus private bank money owned by banks to their customers and borrowers. Increasingly, many central banks want to counter the dysfunction of some bank money regimes and employ bank money that is not threatened by crisis. CBDCs and tokenization. CBDCs are needed to support the most significant positive impacts of asset tokenization, an increasingly targeted mechanism for transferring tangible assets, such as real estate and intellectual properties, for example, into digital tokens stored on the blockchain. With tokenization, anyone can view the process of asset transfer through ownership. Efficient settlement of asset exchange is not as impactful if the cash component of the transaction isn't as equally efficient and able to be coupled into a single atomic update. Wholesale CBDCs, for example, are designed to settle large-scale, high-value securities, transactions, and interbank transfers, affording operational efficiencies around speedier settlement times and greater liquidity when settling other assets like tokenized real estate. In addition, tokenization improves privacy and agility as assets move peer-to-peer without the need for centralized intermediaries within decentralized networks. Governments increasingly recognize the implications of tokenization to improve conventional asset ownership and investment models. Tokenization also provides more flexibility and options under appropriate governance. Examples of central banks. In the case of CBDCs, this enables a new balance between data sharing and privacy needs, providing increased transparency and certainty that isn't possible with traditional technologies. From transfer payment and settlement of an asset to tracking and updating a lien of an asset for credibility, availability, examples, tokenized real estate, CBDCs help to enable a wide range of use cases for tokenized assets beyond just value exchange. With the underlying blockchain technology, the holy grail of instant transfer and settlement via distributive ledger is made possible across any tokenized asset. A new financial frontier. Now, the bad sides of the CBDCs. Despite expected benefits, CBDC deployment is a new frontier and potential challenges should be considered. While these may shift depending on design models, implementation challenges can include increased centralization of payment processing and sensitive user data. It is possible a central bank would store user activity and transactions. That's no good. Reduce regulatory oversight of financial systems. That's no good. Increased difficulty reversing fraudulent or erroneous transactions. Challenges in payment credential management and key custody. Susceptibility to erroneous or malicious transactions. enabled by complex automated financial applications and increased reliance on third parties. Now, we're going to have the pleasure of listening to Brad Garlinghouse speak on a couple different topics ranging from utility, the future, and compliance. He was recently at the World Economic Forum event at Davos. Let's go ahead and hear some highlights.
I think if you look at people's interest in the asset class, it's been very high. And look, I think a lot of people don't want to set up a crypto wallet. They don't want to, incur the extra risk of, managing that themselves. And so the Bitcoin ETF, I think, is a very big deal. I think the institutions that are participating, I've been involved in this industry for about 10 years, and, having BlackRock as one of the ETF providers, sponsors, what have you, is a big deal. Added credibility to the whole industry.
Yep. And any more to say on the part of my question that was just about sort of the difference between this comeback and all of the other comebacks we've seen? I think it's a natural question to wonder for people that might still be a little bit skeptical. Is this just the same old cycle? Are we going to see it go down again? I mean, all markets do that, of course, but I'd be curious to hear your perspective on that.
Look, I think the remarkable thing is that Bitcoin is over $40,000. We've had massive headwinds in 2023. A lot of those were self-inflicted wounds. I was talking to a couple people before the panel. Over the last 18 months, you've had Celsius, Three Arrows, FTX, Binance, and yet here we are, as Michael described, in a really interesting, looking forward position. I'm extremely optimistic about 2024. So I think, if anything, it's an opportunity to step back and really focus on some of the first principles. And what I mean by that is compliance always mattered. I think that we're now at a time, if we want crypto to flourish and achieve some of the things we want it to in the future, I think we have to make sure we stay true to those first principles. We have to make sure we're focused on something more than speculation. Utility has always mattered. I think sometimes we lost sight of that in the fervor. But again, people had, as Michael described, I think it wasn't so many Davoses ago that people were like, Bitcoin's, it's done.
Yep.
And yet here we are.
As well, but for so long now, so much of the criticism of crypto focuses on the use case argument. Like there's nothing to do with it. People talk about, it's being used in this way over here and in that way over there, and then you hear the critics say, like, yeah, but that's not, like, you're really grasping at straws there. And that it's just all about financial speculation and that's it. So I wanted to get your sense of, kind of how you feel about that argument in general, but especially how you feel about that argument now and where we are in the sort of development of the market. Do you think it's fair? What is your response to it?
I think it's a valid argument. As I said earlier, I think 2024, I think we really do as an industry, and as Michael kind of highlighted, that when you go through these, what we have called crypto winters, it's an opportunity to build. And I think you're seeing more of that. And there are more leading companies emerging. Ripple's now at a place where we have focused on real utility of solving a cross-border settlement problem. We've invested heavily in the custodial area. Circle, who I know is in the audience, has definitely demonstrated a real-world use case. I think Fluency, we're solving problems that people see with these technologies. But I agree, what has driven the non-crypto, crypto winters are a reaction to an overhyped cycle of euphoria, enthusiasm, which is just speculation. And I think what we haven't seen yet that I still think we will eventually see is a separation of wheat and chaff of, what are the assets, how are these technologies being used to solve real problems that have real demand versus ones, I'll pick on Dogecoin. Other than Elon Musk as the central actor, I don't see the use case and the purpose, and I'm sure I'll get lots of shit for saying that Dogecoin's not, well.
We've talked a bit about compliance. We've talked a lot about compliance. And there's a lot of sort of pressure or interest, maybe pressure connotes the wrong thing, but of adopting a compliance-first mindset. But what does a compliance-first mindset kind of look like when everything is so sort of different, decentralized, global? You mentioned being frustrated earlier, Michael. Is that a source of frustration for you to sort of kind of receive that guidance without the specific information in place to follow it?
Well, again, I think my answer is going to be, somewhat U.S.-centric, but I'd say that, my business in particular is an asset manager first and foremost. It just so happens that crypto is our specialty, and so our way of operating has always been about asking for permission, not necessarily for forgiveness, right? And so we have had to, within the confines of existing securities laws, continue to develop products and services for clients. And these securities laws at this point are nearly 100 years old in the United States. And so as a result of that and the way that everyone else on the panel is speaking, the innovations in crypto are obviously very much so outpacing the speed at which regulatory considerations can kind of keep up with it. And so I think as a result of that, if you want to be operating a compliant business, you need to do everything you can to engage on a regulatory front. You have to bridge the educational kind of knowledge gap that exists there, because this is just one tiny, tiny area that regulators are looking at and legislators are looking at. And for us, that's been really key to our continued success. Want to operate in a regulated manner. They want to operate regulated businesses. It will moving towards this ethos of anti-establishment or trying to work or be outside the rules. That's really not the case, at least from an inside perspective within the industry.
I'll throw out one quick reaction. In your question, you said something about how is it different, and I'll say I think the question is wrong. Like, it's not different. KYC, know your customer, still matters. Anti-money laundering still matters. In the U.S., you have OFAC and other, I can't name all the acronyms, but I think if we start with the point of view that it's different, it's like, I think the Secretary said earlier, if it's the same, let's regulate it the same. And so I don't think it's that different. The other thing is slightly off topic, but that we glanced over. One of the things I think will happen if I were to predict 2024 and beyond, as big money, institutional money comes in, right now we have one ETF. I think people look at it as an asset class, and I think you will see other ETFs come. And by the way, this is an area where the U.S. is behind. Europe has had effectively a Bitcoin ETF for a few years. And I think you're going to see that spread because people often, particularly if you're in an endowment or an institution, you're not buying one stock. You're not buying one bond. You're buying a basket, and you're diversifying that risk.
Now, in case you missed this from my latest XRP video, this is incredible news. XRP Ledger was pitched to $1.6 trillion asset manager Franklin Templeton as Ripple prepares for institutional use of XRP. Ripple's Chief Technology Officer, David Schwartz, has pitched the merits of XRP Ledger to behemoth asset manager Franklin Templeton, even as traditional finance giants increasingly pivot towards the crypto space. Schwartz's endorsement of XRP Ledger came in response to a recent post by Franklin Templeton that shed light on its interest in the evolving ecosystems of Ethereum and Solana, leading to speculation about potential investments in these networks. Notably, in a Wednesday tweet, the asset manager expressed openness to exploring other Layer 1 blockchain networks, tweeting other Layer 1s outside of Bitcoin, Ethereum, Solana have massive potential, and we are continuing to support, monitor, and develop on these networks as they grow and mature. In response to the post earlier on Thursday, Schwartz emphasized the capabilities of the XRP Ledger. Schwartz, one of the original architects of the XRP Ledger, highlighted its reliability and stability, particularly in handling millions of transactions efficiently for over a decade. He further emphasized XRP Ledger's strength in tokenization and the exchange of real-world and crypto assets. Now, all right, let's dive into some Ripple versus SEC lawsuit news. This is from FX Empire. Judge Torres grants Ripple motion to file surreply letter. The SEC versus Ripple case continues to draw interest, with XRP facing strong headwinds before a possible SEC appeal against the problematic sales ruling. So what does that mean? On Thursday, defense attorney James Phelan shared the latest from the ongoing SEC versus Ripple case, saying that motion to file surreply has been granted. On Wednesday, Ripple filed a motion to file a surreply relating to the SEC's motion to compel. In the motion to file a surreply, Ripple asked permission to correct a significant factual mischaracterization made by the SEC for the first time in its reply. Ripple provided the proposed surreply letter within the filing, which stated that the SEC claims that Ripple does not argue that it would be burdensome in producing post-compliant contracts. That is false. Ripple specifically objected to the SEC's request as overly burdensome. The surreply letter went on to say that the SEC then doubles down on its misstatement, asserting Ripple recently cataloged and presumably produced an ongoing class action suit of all Ripple's XRP sale contracts from 2020 to June 2023, including determining the identity of counterparties to those contracts. That is false. The SEC's motion to compel focuses on post-compliant activity. Judge Torres must now consider SEC's motion to compel Ripple's opposition filing and a surreply letter. On January 11th, SEC filed a motion to compel, asking the court to order Ripple to provide post-compliant contracts governing XRP institutional sales. Financial statements for 2022 and 2023. Ripple opposed the motion to compel on January 19th. As background, Ripple and the SEC are making their way through remedies related to discovery on July 13th of 2023. Judge Torres ruled that Ripple broke Section 5 of the 1933 Securities Act for failing to register XRP as a security for institutional sales. The motion to compel suggests the SEC wants to ascertain whether Ripple continued to breach Section 5 of the 1933 Securities Act. Judge Torres could impose a punitive penalty. However, the SEC must demonstrate that Ripple continued to violate security laws despite the complaint. The document would also reveal proceeds from post-compliant XRP sales to U.S. institutional investors, if any. Proceeds from XRP sales to U.S. institutional investors are a consideration for Judge Torres. It's important to keep your assets, your crypto, safe. Purchase a DCENT wallet through Token Topics affiliate link in the description of every video, and you can receive an incredible discount. Well, everybody, I hope you enjoyed the content. If you did, please do subscribe so you can stay up to date. Thank you.